The COVID-19 pandemic has continued to hit Europe hard in the opening weeks of 2021, with surging infection rates, curfews, and lockdowns boding ill for the region's economy in the first quarter of the year. To discuss the implications of this environment for euro area banks, and as part of the banker's 95th anniversary coverage, I'm joined today by Alex Birry, Managing Director, Financial Institutions at S&P Global Ratings. Alex, thanks for being here today.
Thanks for having me.
Now, obviously, this has been a very difficult 12 months for Europe's banks, but have capitalization levels managed to remain robust despite these difficulties?
Thanks, James. Absolutely. Banks have been very resilient. Resilient from an operation point of view, in terms of continuing to lend to the customers and supporting the economy, but also very much from a financial point of view. And the balance sheet resilience has been evident through this test. So I'd say that it's both from a capital and liquidity aspect. Liquidity to date really has not been a risk factor, so we're not even talking about that in terms of increase in customer deposits, households and corporates. We had, I think, an increase by €1 trillion of those deposits, but also the support from the ECB. But from a capitalization point of view, I'd say as well that COVID-19 has been, the shock has been to some extent a vindication of some of the key features of the regulatory reform of the past 10 years. At the margin, it could be argued as well that the COVID shock is evidencing the room for some potential tweaks in regulations. There have been some interesting talks around maybe the need to rebalance a bit the relative size of capital conservation buffers, which are fixed, versus the more flexible countercyclical capital buffers, which would make the use of these buffers more practical for banks. But by and large, yeah, I'd say the reform has been vindicated. But also, I'd say that this shock is coming to evidence again that even with sound capital and liquidity levels, banks' creditworthiness remains very much a function of the economies they serve, and therefore the substantial support that the economies, banks' customers, but banks directly received were also very much instrumental to their resilience.
The government support across the eurozone area has been quite significant, as you mentioned. Do you expect any pressures to emerge in 2021 on the asset quality side moving forward?
I think that banks are not out of the woods just yet. We expect more resilience of banks, let's be clear, next year. So next year will be another constructive year for eurozone banks. But we do think that things will still get a little bit worse before they get better. And in a way, I'd say that the recovery might be almost a bit of a bittersweet recovery initially for eurozone banks. And I'm using this bittersweet expression because actually we do expect a strong economic recovery, but this economic recovery will be as well the precondition for and the trigger of a gradual removal of support measures. And the gradual removal of these support measures will, in our view, reveal a truer picture, really, of the underlying COVID-19 asset quality impact. So we will see a weakening in some of the metrics. For instance, at S&P, we expect that the 12 months speculative grade corporate default rates will increase to 8% by September 2021. The level was about 4% in September 2020. So we will see a continuing increase in corporate defaults, reflecting the withdrawal gradual of certain support measures, but also the high leverage level of a number of corporates. So yes, we do think things will still get a little bit worse before they get better. That said, banks have been proactively provisioning already in 2020, so they've built a little bit of a buffer there. But we do think that further top-ups will be required. So just to give a bit of illustration in terms of cost of risk, in 2019 we estimate that the average cost of risk for European banks was probably around let's say 30 basis points of lending. We expect in 2020 this will more or less double to, let's say, above 60 basis points before tailing off this year towards more around 50 bips. So a doubling of cost of risk almost, but it's the level that still allows the majority of banks in Europe to post net profits.
On the question of net profits over perhaps the medium term here, we've seen a number of banks across the eurozone pursue fairly aggressive cost reduction strategies over the last year, largely as part of their digitalization agenda. Do you think over the coming sort of 2 to 3 years we might see sort of healthier profitability emerge as a function of some of those strategies and as the economy gains traction moving forward?
Yes, absolutely. We think that the trends, the long-term trends, is a positive one. I put the accent on the long term as well, because I think 2021 will still be optically a lackluster year. If you look at the cost-income ratios of European banks, we expect a cost-to-income ratio of about a median level of about 61% this year, which is still relatively high, although it masks a very disparate picture across the region. And for this year, it's no surprise really, because you still have quite a bit of pressure on the revenue front. Loan demand might start to tail off a little bit as a number of corporates start to grapple with high leverage levels. And margin obviously are under pressure from the low for longer environment, even if the ECB's TLTRO's interest tiering might prop up a little bit the margin, but still. One way to work on the revenue front for banks in the low for longer environment is maybe to move more towards a fee income earnings model, away from using their balance sheet, but that's a long-term trend. So the main lever still at the moment is really on the cost front, and we've seen lots of measures being taken by European banks on that. It's not new, but I think that COVID's been really accelerating certain trends, thinking about technology, which means that customer preferences, but also the way we work has changed, and that's I think the banks have very much acted on that already in 2020, realizing that there's a lot of opportunities around their real estate footprint, and therefore we are seeing actions, but the effects on the cost are not immediate, because at the same time, banks have to invest in technology. So you have upfront cost, but for longer term gains. So that's why in 2021, the picture might still be a little bit lackluster, but with better potential after that.
Alex, thank you for your time today.
My pleasure. Thanks, James.